So, but still I am still not clear what is this covariance correlation. Don't worry, let us go to that. I am spending some time on this covariance and correlation. Don't worry about the formulae, what I have basically put about here. That is what we will discuss as we go along. Variance and standard deviation measures only the variability of the individual stock. Covariance and correlation measure the relationship between the returns of one stock and the return on the other stock. Measure the relationship between the returns. That's all. That is what we call it as covariance and correlation out there. I have got further explanation of the covariance and correlation. How do you interpret covariance and correlation? Covariance are, I forgot what do you call it as the let us look at the interpretation of covariance. If it is positively correlated, if it positively covaries, that means there is a positive dependency of one stock on the other, A and B, Slopak and so on, whatever the other one. If it is positive covariance is there, then that means what? One is dependent on the other. There is a dependency, mutual dependency on both these stocks. The relationship between these two, there is a positive relationship between these two states. That is what I have got. Interpretation is, in any state where both the returns are above their averages, in any state where both their terms are below their average. That's fine, that's okay. That means there is a constant relationship between the two. If it is negatively correlated, it is negative dependency on each other, negative dependency on each other. Zero correlation, no relationship between each other. Negative correlation, covariance and the negative relationship between each other. Sir, what is this number? This is exactly the number that we obtained in the previous example out there, because we saw that this is the formula what we basically use, and then based on the formula out there, we basically arrived at this number out there, that is covariance of two stocks out there. What return of one stock is likely to be above its average when the return of other stock is below the average, and vice versa, because what? They are negative dependency on each other, negative variation, covariance, they are negative dependency on each other out there. Now then, what is correlation? Let us look at what is correlation. Positive correlation means the stocks vary, the variables are positively correlated out there or negatively correlated, and they are uncorrelated. Correlation will always be negative, -1 and +1. What do you mean? See, the graph beautifully explains. Look at the first piece of graph. Both have sort of overlapping graphs. Both stocks have A and B have overlapping features out there. When A moves, B also moves in the same direction. B moves in the A moves down, B also moves down, or B moves up, B also moves up. It is going, what do you call it, as being very parallel. That is what we say. This has a positive correlation of +1 in this case. Exactly move in the same way. The second graph, if you look at, A and B moves exactly in the opposite direction. When A moves up, B moves exactly down, A moves up and B moves out, and then so on and so forth. This perfect, it's a perfect negative correlation, -1. Whereas C, if you look at the third graph, A is moving independently, B is moving independently. They don't have any relationship between the two. So what happens? It's a stock which is basically what we call it as zero correlation in this particular case out there, and that is explained out here. In this case, that is, the return on security A is completely unrelated to the security return on security B. Whereas in the second case, if I read it, security A is higher than average return when security B is lower than average return. Whereas when I look at this, for first one, both the returns of security A and the return of security B are higher than average at the same time or lower than average at the same time out there. So in this particular case, negatively correlated, that is where we have return out there. Covariance is negative. Return of one stock is likely to be above average, one return of one stock is likely to be below average, and vice versa. Now I have example 2 out there. These are basically the expected returns out there, 17.5, and where it's basically what we got. Expected return of slowpoke was 5.5, variances we got 6x, your variance of slowpoke also we got, and standard deviation of both basically we basically got. I've just put it up and from the textbook I basically picked up out here, and that is what we talk about out here in this case. I've taken some correlations. Correlation between General Motors and Ford expected to be high because both are in the same sector. Correlation between General Motors and IBM expected to be low because different sectors, it need not move together. The policy may not affect both the companies in the same way because completely different business out there. So, we are looking at co-movements out there. Correlation between General Motors and Ford is much higher than the correlation between General Motors and IBM out there. So, going further, we look at the risk and what do you call it as a return of a portfolio. We are looking at not individual stock of a portfolio. Investors always have a different estimates of the return and the deviations, standard deviations and correlations of between securities out there. That is the expectations of the investors out there. Now, how do investors choose a combination in a portfolio of securities and to hold etc. out there? They will always build a portfolio with a high expected return and a low standard of deviation between the return. Portfolio, all the stocks put together should have a very high expected return, but with a lower standard deviation out there, and that is what we look at, expected return of a portfolio. So, when we say expected return of portfolio, we do nothing but the weighted average of the expected return depending on the weighted average. Weighted average is the percentage of money you are putting in each of these instruments in the portfolio. So, weighted average of the expected returns and the individual securities out there. The same thing, when we continue that, we did calculate covariance and correlation. I have just mentioned that those figures out there in this particular slide out there. Let us move on. Variance and standard deviation of a portfolio. First term, variance of security A, that is variability of the individual security, what we looked at in this variance of a portfolio. The second term is nothing but that is 2xa and xb and the standard deviation A and B, that is nothing but the covariance between these two securities, that is how well are they related. The third term is nothing but the variance of security B out there. Again, positive relationship between the two returns, increase the variance of the portfolio, negative relationship between the two securities in the portfolio, decreases the variance out there. Why decrease the variance? Because when one moves up and moves down, so it is sort of offset out there, so decreases the variance. When both are moving up or both are moving down together, positive correlation, then your variance is expected to be high out there. Now, in this portfolio, I am looking at the next one. Construct a portfolio of Supertech and Slowpoke with 60-40 investment out. The 60% I am going to invest in Supertech and then for Supertech and 40% in Slowpoke, and what is going to be the expected return. Let us sort of look at that portfolio out here. Let us go back to Excel in this particular case. I got it out here. That is, all these things are stated from, I have obtained it from there. Expected return of Supertech 17.5%, you saw that 17.5% out there. Expected return of Slowpoke 5.5% we calculated. Supertech variance, Supertech's Slowpoke's variance, standard deviation of both, covariance and correlation of all this I have mentioned. I got 100 rupees, I invested $60 in Supertech and $40 in Slowpoke. What is my expected return out there? What is my expected return out there is first a question, and then the variance and standard deviation and so on and so forth out there in this particular case. What is the expected return is the first of the portfolio out there. So, the rupees are basically converted to the decimals, so the 60 and 40%. So, what is the expected return? Expected return is 60% of my investment is going to earn a 17.5% return plus 40% of my return investment is going to earn a 5.5% return, and this is going to be the portfolio return out there. The portfolio return in this particular case is 13, or let us say it is about 12.7% is the portfolio return out. 12.7% is the portfolio return out there. So we had this. Now what is the first variance? Variance is what is the first term? First term is nothing but the probability square, that is the 0.6 square into the variance of this. So let us look at in this particular case, I am going to look at in this particular case the probability of this to the power of 2 into the variance of Supertech out there, that is all is the first term. What is the second term? Second term is 2 into 0.6 into 0.4, that is the probability of both, into covariance of A and B out there, and this all is going to be the second term out there. What is the third term? Third term is probability of this square, probability of this, that is the second probability of this occurring, square of the probability of this into the variance of this is the third term out there. So what is the variance? Variance is this plus, this plus, this is the variance out there, 0.02 is the variance out there. What is the standard deviation? SQRT of the variance out there is the standard deviation, and this is what is the standard deviation of the portfolio is about 15 point some percentage out there, 15.44% is the standard deviation of the portfolio out there. I go back. Now going further, in this particular case we constructed this. What is the effect of diversification? Why do we diversify out there? That's exactly what we calculated. I just put out here 15.44. Due to diversification, the what do you call it as I've got put in the diversification. Both the companies are slightly negatively correlated that we saw out there. That is what I given the negative correlation. Supertech's return is likely to be a little what do you call it as below average if Snowpark's return is above the average out there. That is, they move in the opposite direction out there. Supertech's return is likely to be slightly a little above average if Snowpark's return is below average out there. There is less benefit from diversification of two securities if both the securities exhibit either positive or either negative correlation. If both the securities exhibit positive correlation, then you will have very less benefits from diversification, and that is what is the third statement says. The diversification benefits will become the diversification benefits will be completely eliminated if both the securities are positively correlated out there. That's why as long as the correlation is less than 1, the standard deviations of the a portfolio of two securities is less than the weighted average of the standard deviations of the individual securities out there. Let's leave it there. What is diversification? Variation among the individual stocks is reduced through diversification. That is, one varies this way, the other varies the other way. So what happens? The overall variation of the portfolio is reduced. Then how is it good out here? Let us look at what you call it. Now we come to the two different kinds of risk that I call it as systematic and unsystematic risk. Now what is the difference between systematic and unsystematic risk? Risk is unanticipated part of the return, that's all fine. Systematic risk is what we call it as a market risk. The market rate affects a large number of assets each to a greater or lesser extent. For example, macroeconomic factors affecting, as I've listed, GNP, interest rate, inflation, all these things is going to affect a large set of stocks, but we call it as the systematic risk. Large set of stocks in the same direction. Please note, in the same direction. The direction is not going to change. It's going to impact the stocks in exactly the same direction. Systematic risk cannot be diversified. Unsystematic risk, it is specific to individual stocks. It is specific to individual entities. For example, there is a particular problem. Let us look at the recent case. Raymond's had some internal issues. Raymond's between the promoter and his family. So what happened? It did not impact the entire textile industry out there, it impacted only Raymond's. So that is what we call it as unsystematic risk. Now how can I avoid that? Because of that, the market fell for only Raymond's, not for the other textile stocks. So how do I take care of that? I will diversify my portfolio. I will diversify my investment into a couple of other stocks out there. So when I'm dividing my money into a couple of other baskets out there. So Raymond's is going down, but others are stable. So overall, I'm getting a decent return out there. So this is unsystematic risk. Unsystematic risk completely can be eliminated or minimized. I shouldn't say eliminated, I would say minimized with the help of diversification, whereas systematic risk cannot be eliminated with diversification out there. The essence of diversification out here, that is the same thing what I mentioned. What happens when we combine stocks, flyer stocks with another stock in a portfolio? If I look at maybe a positive for one stock, when the epsilon for the other is negative, and so on and so forth out there. In simple, unsystematic risk is specific risk. It can be minimized by diversification. That is all what we look at, and I took the example of Raymond's out there in this case. That's what I've explained the risk with the help of a graph out there. There is a minimum level of risk, and that is what you see out here. Minimum level of risk out here, where I am going to use my pointer out here. There is a minimum level of risk out here. You can see my pointer on the screen. This is what is a systematic risk, and this risk is uniform across all firms. Over and above that is what we call it as the unsystematic risk. It varies. For example, if I invest in only one stock, my systematic risk is going high. If I invest the same money in a basket of stocks, what happens? My unsystematic risk comes down and gets nearly eliminated. I won't say it's always slightly above, it is nearly eliminated out there. So I am born only with the systematic risk in this particular case, and that is what you see out here. And that is exactly what I have explained in my slide out there, as you can see on the right out here. Now the next aspect what we are going to talk about is beta. Let us talk about this in the next session.